Welcome back, everyone. If we are still outside, please come into the auditorium. Those of us who are here, we can take our seats. As we're doing that, allow me just to continue to thank our sponsors for this successful event. The platinum sponsor, which is Old Mutual. Our gold sponsors, Insight Actuaries and Consultants. First Mutual Holdings. Our silver sponsors, AAC and NASA. Our bronze sponsors, which is CBZ Holdings, Independent Consultants, Clanex Actuaries, and UNEFCA, and Econet Life. We just want to continue to thank our sponsors. Wonderful. Thank you so much for all settling down. We have an exciting segment that we're about to get into, which is our panel discussion. Allow me just to call up our different panelists that are available with us today. We want to call up Anesu, Daka, if they're here already. Let's put our hands together while our panelists come up. Rumbidzai, Matiki. Please take a seat, any of the seats. Yeah. Tawanda, Chituku. And Albert, Jakara. Thank you so much. I hand over to the panelists.
Good morning, everyone, and welcome to this session of the 9th Actuarial Convention. What is our theme? Does anyone remember our theme for this year's convention? It's building resilience. Yes, and IFRS 17 comes in and starts testing that resilience. So my name is Tawanda Chituku. I'm an actuary. I'm the managing director for IAC Zimbabwe, and I own a company called Next Vantage Holdings. I work with insurance entities on transformation, social security, and I've been involved in a number of IFRS 17 implementations. I've done over 25 implementations, and I'm still doing IFRS 17 implementations. On my left is Albert Jakara. Albert is a group finance executive for CBZ Insurance Cluster. Albert is a chartered accountant. He has been with CBZ for a number of years. And Albert has actually overseen the implementation and transition from IFRS 4 to IFRS 17 for the CBZ Insurance Cluster. Albert, just introduce yourself to the members.
Good morning, and what a pleasure to be part of this conversation. I think Tawanda has nailed it. Happy to have a discussion with the actuarial team. I think what has happened with the implementation of, with the introduction of IFRS 17, I think actuaries wanted to be part of the bigger cake. At this stage, I do not know how the standard was crafted with so much involvement of the actuary. But I think going forward, actuaries are going to be so key, I think, in financial reporting matters. So I'm happy to be part of this, and hope you enjoy the discussion. Thank you.
Well, the Bible says that rock that you rejected is now the cornerstone. You're now leaving it. On my right is Anesu. Anesu is a chartered accountant. He's involved extensively with implementation of IFRS standards in general. And he has worked very closely with PAB. I'll let Anesu just tell us a little bit more about himself and his work, and specifically narrow it down to this discussion about IFRS 17.
Thank you. I'm quite excited to be here. And I was sharing just now how I'm excited, having walked the journey. I'm, I'm one of the youngest commissioners in the Just George Smith Commission, and I was reflecting that during the time we went through that, the society was not this huge. I'm really excited and proud of you, ladies and gentlemen, for having coming so far. Then it was a handful of people, but today I see a whole big society building resilience. I'm sure you need to give yourself a round of applause for that. And just to highlight that during that time, we also got to understand that Zimbabwe was the president, the lady was leading the British, the UK association, Marjorie, and Zimbabwe had so many actuaries, but who were not practicing here, and there were no standards like the mortality table which we're talking about. So it's quite exciting, and I think we come a long way, and I'm very excited to be part of this. So I come from the commission, and I'm happy to be here. I lead from implementation of standards in the region. In terms of IFRS 17, we've gone as far as Malawi in terms of the actual implementation. So I've seen a little bit of the variances across the region. I refer to myself as a standard setter as well, because I work with the standard setting bodies, PAB, ISB, in the writing and implementation of the standards. Other than that, I also lead from the board as a board member, also talking to these issues. Thank you.
Wonderful. I'm quite happy that Anesu has vast experience, and thank you for the comments about the Actuarial Society. It would be remiss to not mention the contribution made by our past president, Mr. Douglas Otto. Is one of the founding presidents of the Actuarial Society, and we have a number of war veterans in the actuarial field who are seated here. We have the likes of Micah Fesu, we have Lorraine, a former president, David Mreriwa, Shepard Fungura, who would not be here without your effort and selflessness. Let's give them a round of applause. The last with us, and I'm quite happy we have a lady on this panel. We were previously criticized that all AZ panels did not have a lady. So congratulations. So we have Rumbidzai. Rumbidzai is coming from an audit perspective. She is with Deloitte, and she will give us some insights on how we're going to balance out actuarial contribution and audit preparation. So Rumbidzai, just tell us a little bit about yourself, and we'll be happy to then take it from there.
Thank you very much. Good morning to you all. My name is Rumbi, and I'm an associate director with Deloitte. I've been with the firm. This is my 16th year now. I'm also part of the technical committee. With regards to IFRS 17, thus far we have been keeping our clients to task in terms of making sure they are on track with their project, as well as their project management skills. And this year is really when our work kicks in terms of assessing what really has been done and its appropriateness. It's also interesting because from an audit perspective, we also do feel how the actuaries are now the cornerstones, because now we really rely on they are really holding the fort, and they are leading us. So looking forward to an interesting discussion.
Okay. So I think let's get started. So we have 4 segments, and each segment is going to be rounded off with a 5-minute question and answer session. And the first segment is introduction and background. We're just going to discuss a little bit about how we moved from IFRS 4 to IFRS 17. It was an 18-year journey, but now we are finally here. And then the second segment, we're just going to talk about implementation in the actual battlefield. What has happened, who are the boots on the ground, and what have the experiences been like. Then our third segment, we are talking about going live. What are the key practicalities around going live? And our last segment is in the IFRS 17 space. So we're looking at KPIs, what does it mean for financial reports, how do we interact with regulators, ZIMRA, IPEC, RBZ, issuing statements every 2 days, all of that stuff, how does it dovetail with IFRS 17? So I'm going to start, and then I'll hand over to my colleagues for comment. The first thing was, IFRS 4 was clearly an interim standard. It was just holding, it was a placeholder, paving way for the standard IFRS 17 to be introduced. Now, for that to be the case, it means there was something that was not quite sitting right with IFRS 4. If I do a mathematical example with you guys, IFRS 4 was a bit like, I've got this bottle of water, this one. Can you all see it? Okay, you can lift it if you want. Okay. So I've got this bottle of water, and I make 1 million of them. All right? And each one, I can sell it for $1. So how much do I have in terms of stock? I've got 1 million bottles. I can sell each one for $1. So how much do I have in terms of stock? Okay. So if I go to my revenue account and I say, if someone says to me, what was the revenue for this year? And I put 1 million. Is that correct? Is that correct? No, right? Unless I sold the actual million. Well, I'll say to someone, well, I put revenue of 1 million, but I still have 800,000 bottles that I have not sold. They're still in the warehouse. So I'm going to go and do a reversal. So I put 1 million, then I reverse 800,000. And then the next question you're going to ask me is, so why did you put the million in the first place? Okay? It's like you're dating a girl, and I say to you, are you married? You say, yes. I say, where's the marriage certificate? You say, no, it's in 2 years' time. I say, hey, man, but you're not married, huh? So IFRS 4 had this thing of counting premium as revenue, but premium represents things that have happened and things that are going to happen. Now, if I'm running a company that sells water, surely my shareholder and my board, they want to say to me, how many bottles did you sell? At what price? And that was the revenue. That's what everybody else does. Insurers felt they were special until IFRS 17 said, no, you're not special. All right? So we're just going to go to issues that we know with premium from a short-term point of view, from a life insurance point of view, from an accounting point of view. What were the key issues that we faced with premium that led to the development of IFRS 17? I'll start with you, Albert.
Thanks, Tawanda. Perhaps just to add on to the points made by Tawanda, you will note that we do have a couple of products, I think both on the life side and on the short-term side. To your point, what we should ideally consider as revenue is that which is in the bag. So you will notice that under IFRS 4, you will have revenue, you will have premium, you have collected premium, and that premium is in lieu of the risk that you're actually carrying. So until that risk materializes, or until we've dispatched, or until we have the policy has run through its full cycle, that cannot be revenue. Together with the fact that the premium that you're actually collecting, it does have some investment component, which is not premium. For life policies, those can span 10, 15, 20 years. So if we do take those premiums as revenue, certainly there's a challenge. We want to call revenue properly. We do have another standard, I think, that deals with revenue, which is IFRS 15. The coming in of IFRS 17 is certainly borrowing concepts from IFRS 15. We should call revenue as revenue. Where there is interest, we call it interest. It's not part of the risk. What you also notice under IFRS 4 is that the cycle in terms of revenue collection is slightly different from that which is recognized under IFRS 17. There is a risk adjustment that IFRS 17 actually introduces. If there's a shareholder out there who has put in some money for carrying such risks, there is a possibility that things can actually go wrong over and above the risks that I'm actually carrying in terms of the future collectability of the premiums as contracted by our clients. So all that needs to be taken into cognizance. So there was everything wrong with IFRS 4, and IFRS 17 actually comes in to correct such anomalies. I think that actually caters for both short-term and the life side. I think in a nutshell, from an operational point of view, from a financial reporting point of view, those points are really valid as we look at IFRS 4 versus IFRS 17. Maybe I'll pause for now. Tawanda, maybe let's hear Anesu.
Thank you so much. Wow, when you look at IFRS 4, we had a very big problem, especially in Zimbabwe. In 2012, I was privileged to have done a study which was overseen by the Institute ICAS and IPAC. And what came through was mostly because of the inadequacy of IFRS 4. So let's start with one of the key aspects that really brought this one thing out. It was the inadequacy of the definition or the scoping on what is an insurance contract. I think one of the key aspects was you think insurance contract, you think an insurance company, and that's it. But by that time, we saw things like there was some sort of product that was coming, Lobola something. We had the legal aid, okay? There's still, I guess, the placement of some of the NASA products within what is insurance and where they're supposed to be regulated and how they're supposed to be accounted for. So if it didn't fall in there, I'm looking at medical aid even, if you come today. So IFRS 4 couldn't really help in some of those aspects. The second issue was the issue of insurance debtors. Coming from the issue that he raised in terms of the accounting for premium, so we will pull everything in. Now we had a challenge because I think I've seen that across the region. One of the challenges that we have is we raised premium both on what has been received and what has been the bookings without actually receiving, whereas the law of insurance says prepaid. Okay? So we then had insurance debtors. And come end of year, one of the biggest challenge was then if there is not been performance, if you look at the individual side versus the corporate scheme side, if there's been a performance, if I have been put my car and I've not claimed or there's not been anything, people would normally walk away as individuals and go and open a new account, a contract with someone else. And you are now left with an insurance data on your books. And the question has been, do I write off? Because writing off means that there was a contract in the first place. Or is it a contract reversal? Okay? And some of those things were not very clear as guided by the standard. And the challenges of that is, how does this affect the reserving? Because if we had booked all these things on, when we go to do reserving, some of that will eventually impact the liabilities. So these were misdemeanors as far as, so in other words, when you look at the contract boundary, which IFRS 17 is bringing now, then it was not very clear. At what point do we say over the contract, right? So IFRS 4 had quite a number of gaps, and an insurance company could say they are so big with insurance debtors and so forth, which will never perform eventually. Okay, so I will just submit those few.
Right, so you're saying in Zimbabwe, we've had the problem of the bond note. So you're saying IFRS 4 was a bond IFRS. Do you have any further comments?
Just around why the standard came into play. So with IFRS 4, the focus was more on the statement of financial position, the balance sheet. But IFRS 17 is correcting that, bringing in focus as well on the statement of comprehensive income, which is your income statement, as well as in the way it presents the premiums. Then another point is just around the adequacy of the disclosures. So again, it was a bit difficult to compare results across the industries because different entities would apply different methodologies, which was appropriate for the insurance contract liabilities. But now IFRS 17 is coming, bringing everything together, putting principles on how to determine those insurance contract liabilities, and then requiring specific disclosures. That's making it easy for the users to be able to compare results across the different entities.
Okay. So if I were to summarize from my panel here, Albert said it's important for revenue to give a reflection of what's in the bank, right? I think that's a key point from an operational point of view. If I look at your revenue line, I must surely be able to go to the bank and see that money sitting in the bank somewhere. He also said premium included other aspects that are not of an insurance nature. So you have your investment elements, you have other riders of a service nature, maybe driven by IFRS 15, that are also part of what is called premium. So that becomes an issue. It lacked risk adjustment, which rightly reflects what the shareholder is looking for in getting in business. Then Anesu talked about insurance contract mismatch. IFRS 4, Ibama Zonke, everything just comes in, but IFRS 17 rightly defines if there's no transfer of risk, then that's not an insurance contract. Then the issue of reversals in terms of treatment of that revenue. Then Rumbi finalized the discussion by saying IFRS 4 was strong on reflecting the balance sheet, and if you got it right, then you have enough capital, so everything is fine. But that means your disclosures are not adequate in what's driving that balance sheet, all right? Now, IFRS 17 comes in, and to the actuaries here present, how many of you have done an analysis of surplus? The young ones, I can forgive you. But all the seniors in this room, you have done analysis of surplus, right? So IFRS 17 converts your old income statement, the new comprehensive income statement of comprehensive income is like an analysis of surplus, right? At the top, you have your budgeted entries. At the bottom, you have your actuals, and it shows clearly what's driving your profitability. And accountants use this very effectively in their budgeting process and in their board reporting process. Very important. Everyone knows what is caused a profit and where have we lagged. We want to get into history of development of the standard, and Anesu is going to help us just to tell us how that has gone. And I may just say at this point, from my understanding, IPEC did surveys on IFRS 17 preparedness. You see, we like to curse IPEC, but sometimes they do a good job. So they did preparedness surveys from 2021, and guess what we said? What did we say? We said we are ready. And IPEC ran to Minister of Finance and said, these are the submissions from industry. They are ready, okay? Except on the day of reporting. So Anesu, please tell us the history of development from an IASB point of view, from a PAB point of view. I think let's also place it rightly. Who owns an IFRS standard in the country?
Thank you on that. I think it's very important to know, like you say, IFRS 4 is one of the old standards, right? On the IFRS, it comes from the earlier on standards, and they said, if we can define the insurance contract, I think we've achieved. And I think that's mostly what it managed to do, right? However, the diversity of practice was amazing across the developed and there was then a number of things that also was quite critical. The movement of solvency, which I think you guys appreciate very much. And on the banking side, it's the Basel. Okay? These things were moving at the same time the standard needed to be. Okay, and it's very important because I think later on we'll also talk to IFRS 9 in relation to this. Because when I look at a balance sheet of an insurance company or a pension fund, I see the risk that's, especially from insurance company, I see the risk that is you've underwritten and you've got those liabilities of promises. On the other side, you receive money and you put them in instruments which conserves value to honor the promise at a certain point in time. So from standing back, you see solvency. On the other side, there is the financial instruments which links with the banks and so forth. And the bank assurance did not make it easy because I'm sure quite a lot of those also brought the banking, combination of banking and insurance in the same play. So the standard took a little bit longer, but it came, and I would like to point this and the issue that you're raising. When a standard is being developed, we don't start with writing the standard. We start with practice. What is actually happening on the ground? Is this pervasive? Is this Anesu's issue only? Or is this a shared issue? And we mostly write a standard for a shared issue. So what's happening across the world? And we do that, which means the Zimbabwean peculiar issues are not part of this. Okay, so it's very important to appreciate that. So that process took long, but it came through, and I think we would say IFRS 17 was actually issued about 5 years ago. 2017, right? And what that means is when a standard is issued, before the issue, there is a whole stage. We had an exposure draft. On the exposure draft, I think the exposure took a little bit long as well, about 2 or so years in exposure. It means that the first principles are available for us to comment. And in that, we have an opportunity to air our views and our experiences to be considered. I would like to give you a very interesting example. Most standards say if there is an interest component, time value of money within a year, it is considered to be immaterial and it should be ignored. Is that correct? A 1-year contract. Do you believe that that's correct for Zimbabwe? No. At 150%, 100 and something percent. Okay, so when the standard is written, it's written on generally accepted principle or practice out there. But exposure drafts then comes in for us to then come in and comment and say, we see this, how then should it be considered? So that they then give guiding principles for such. So that happened, and for IFRS 17, Zimbabwe did not participate very much. Okay? We participated, but not with the actual practitioners. It was packed. Then 2017, the standard came through. We were given time. And during that time, I think the focus became IFRS 9. Everybody went to IFRS 9 and forgot IFRS 17. So that time, and then there was the extension, 2021. Is it 2020? Yes, the 21st, okay? And we also did not pick it up. And exactly as you point, we missed. But I want to raise a very critical issue on the standard setting. When a standard is issued from 2017, but not yet effective, it is a period which the industry is expected to prepare and make itself ready for implementation. So we should already by that time start testing our contracts against the standard, and already certain disclosures needs to come through to prepare users and stakeholders in terms of what the standards mean. Do you know what happened? I think I did a study on Zimbabwe, Malawi, and South Africa it's an IS8 change in accounting policy. And most entities, especially for this one in IFRS 9, would say not yet ready, still determining implications. And till today, that's what we are still saying. And only in 2023, boom, we will have IFRS 17 compliance. And you're saying, where are they coming from? So, in other words, we've not used the opportunity that the standard has given us in order to be ready, to learn, and to test ourselves. Thank you.
All right. Now,
Sorry.
Yeah.
Just to comment, I did attend, I had the privilege of also attending the IFRS 17 in Daba a few months ago. And it was interesting that the PAB mentioned that preparers had been requesting for extensions in terms of the implementation. And a question was posed as to what people thought, how much longer people required. You know, there were answers 1 year, 2 more years, 1.5 years, 3 years. But guess what? The average was 6 months. So it just clearly shows that people were not, you know, really prepared and getting ready for the standard.
Wonderful background that you've given us. I think what's clear, IFRS 17 is not an IPEC standard. It doesn't belong to IPEC. It's a country. As a country, we have a public auditors and accountants board which looks at frameworks of reporting, and we have signed as a country to the International Financial Reporting Standards. Right. So I want to take questions at the end of this segment, 5 minutes. Then we're going to get into second segment where we're going to talk of implementation. Rumbi, I hope you have looked at IFRS 16 implementation. When IFRS 17, I hope you have some experience of that. We want to draw a few insights on what you saw when IFRS 16 came. You've also seen IFRS 16 come in. So we'll draw from this team what they've seen with IFRS 16, and we are going to draw those lessons and go on to IFRS 17. Madam, can we have questions?
For this segment. Thank you so much. Yes, we've got a question up here. Please just bring the mic.
Thank you. So my question is on that last bit that was touched, which is on how standards are prepared, are written, and the time that is afforded for implementation, and how we should be participating. So we are finding ourselves like we've been put in a corner, but we have really put ourselves in that particular corner. So what is it that we need to do to change that? Because there was time to do a proper implementation and to work through this with the rest of the world. The standard was actually deferred by a further 1 year, which means if we are still saying we are not yet prepared, I think the generosity that has been granted before, we have not really used it. So what is it that we need to do as a country to change that? Because I think it might be a pervasive challenge that might continue in the future if we do not nip it in the bud.
All right, there is a question.
So I'll put a number of pillars. So the first pillar that I want us to make stronger is the pillar of collaboration. When you look at this issue, it can't be an accountant or auditor story alone. It needed the actuary. So the first part is what I call continuous professional development. As a professional within as an actuary or an accountant, so you are either in finance or statutory actuary, as you do your CPD, these things you participate in, and then you need to bring them to reality, to your current practice. So I then give responsibility to our institutes or practicing societies, like this, okay, to go and engage and have very good collaboration at institute level, but at the same time a very good relationship with the regulators. Because then we bring it to the regulators, this thing is coming and we need to. And we prepare our members. Unfortunately, for these, they are said to be specialistic standards. For accountants, they are not taught in class. Okay, sorry to say that. They are not necessarily taught in class. They are specialistic standards. And I think that's why it didn't quickly hit on everybody. But if we're working together and collaborating, both shared at a society level, we should be able to. So I think the first thing, collaborating and having certain meetings or meets which talks to the regulator at the same time. So I think for me that was the most important aspect that we need to bring. That also talks to how we relate with the valuers. So I think on a certain presentation that I saw here, where we were referring that valuation we should also be talking to IFRS. I think it's much more the international valuation standards and the valuers. We tend to leave them. So the problem that happens is our lack of knowledge of what actuarial perspective and practice is from an accountant's point of view keeps us not moving and realizing that we need each other to have driven this. So this could have happened long back then and would have moved. I think for me that's the core aspect. Establish collaborations that are run at an institute level and having certain things that we move together because we are key drivers of an industry.
Maybe a mic on this table here. Can you take a mic on this table here? Oh, you've got it, yeah. From business, do we have a culture of rewarding people who take time to implement, educate within organizations? I know you are managing a jigsaw puzzle. When you wake up, I can guess what your day looks like. You first have to go and fetch water next door with a bucket to bath, then crank up your generator for power. So I know you're juggling a lot of things. We're in Zimbabwe. But do we have a culture in this country where there are budgets that support transformation, Mrs. Transformation over there? Do we have budgets? What's your take?
All right, I think it is a jigsaw. So I think at this point in time, I would say it's a nice to have. So we aspire. I mean, when you look at our strategy documents, that's there. We want to be innovative. We want to do all these nice things. But I think our challenge is on the implementation. So we are probably, as you said, in Zimbabwe, we're firefighting most of the time, that we don't actually put aside enough time for this very important aspect where we actually need to innovate and do the needful. I was just sharing with my two colleagues here that what Anesu described is the typical Zimbabwean situation. We start discussing once the horse has bolted. So I think it's something we, at a national level, not just at a business level, that it's something that we actually need to address, that early collaboration and actually mapping a way forward.
Please tell your colleagues at Deloitte,
I think you're right. I do agree with you 100%. My experience with the corporate world is that introducing non-accountants to an accounting standard, it happens year in, year out. You guys still get numbers. You still go through financial statements. No, look, we'll get them, right? So the moment you start talking about a budget or a training for accountants, you start hearing loads and loads of stories. These guys want to spend, they want to go and enjoy. Yet from the business side, you submit a budget, they don't have money. So it's always a tussle between finance and business. So you are indeed right, Tawanda. We need to have that corporate culture of supporting these developments. It's not easy. for accountants per se. If you look at the past 3-4 years, we've been in this hyperinflation period. For this very same accountant, they produce 2 sets of numbers, your historical financials, your hyperinflation. So not only are they incapacitated in terms of resources, they are also incapacitated because of time constraints. So to actually go through these CPDs, it's indeed a challenge, especially for a Zimbabwean accountant. Thanks.
President Shiduza, he has left the room. Okay. Okay. Now, obviously, following Tawarai's comment, there is an opportunity to, if we as business are dealing with these aspects, but we have an academic fraternity, sometimes it's all about business putting together a small wallet, maybe 5,000 or 10,000 US, to say we want papers from academics on impact of IFRS 17, impact of this standard, this and that. Because what I notice, you go to IACA conference or you go to ASA conference, there are many academics who are sponsored by organizations, and they come and they present their findings. Very educational. So probably in our efforts, we may just need to recognize and acknowledge that we need this culture of investing and rewarding people who actually come with insights. I think I want to move to the second segment, and thank you very much for your insights in this first segment.
Just a last one for me. I'm sure for those that connected with the multinational organizations, you find that in certain jurisdictions they've got what we call a technical reporting accountant. Or even, I'm sure some even have for tax. In Zimbabwe we don't have tax people, but what that person does, they always are looking into the future. What's the future bringing? Are we ready? What does it mean for us? They are not focused on the admin. For us, as an accountant, we have the admin and everything, such that that technical is not, and these are the people that participate in this process. So I just want you to think about it. So that technical can be an individual or organizations that look and help us, guide us in some of this. Yeah.
Okay, I want to move to the segment 2, unless anyone has a burning question. All right. Anyone with a burning question? Okay, so we want to move into actual implementation of IFRS 17. It's a very complex standard. I spoke to a colleague in this room, I saw him, and I said, how has it been? He says it's a PhD in insurance. Right, so we want to go to implementation approaches. Albert, you have literally overseen a full end-to-end implementation. I know you've worked with many consultants, you've worked with auditors, you've worked with actuarial consultants. Rumbi, you have overseen actual go-live and transitions. You've been sitting on that desk as the auditor. I don't know, Anesu, if you have been sitting in that implementation chair, but we do have a lot to draw from. I want to start from IFRS 16. So IFRS 16, just for context, it also caused a lot of noise when it came, right? I'll start with you, Albert. Just tell us the noises that were caused by IFRS 16, and Rumbi can also add on to that one.
Thank you, Tawanda. I think to start with, the very same issues I think we are grappling with on IFRS 17 are the sort of issues that we also faced under IFRS 16. There are always some budgetary constraints. Firstly, from an implementation point of view, we face challenges in terms of support. I think from senior management. Then we also faced issues to do with discount rates. This sort of environment is so fluid, and we do not have a uniform rate that we can use because of the dynamics of our market. Data itself. I know earlier on there were issues to do with statistics and stuff. The environment we operate in, it's not an easy environment. So the very same issues that we faced under IFRS 16, we will catch up with those under IFRS 17 as well.
I think, Rumbi, as you come in, just give us insights on what IFRS 16 is. What did it do?
Okay. So just for context, at a high level, IFRS 16 is a standard for leases. And the biggest change that came about is with the old standard, where an entity was leasing out an asset under an operating lease, you just recognize the expense in your income statement as the expenses incurred. But IFRS 16 changed that, and it now required entities to actually put those assets on the balance sheet with a corresponding liability in terms of the expected future payments for the duration of the lease. So just around what we saw around implementation, in addition to what Albert said, I guess we all know that Zimbabwe is very unique. So our hyperinflationary environment did cause challenges for preparers, because you would find rentals would be changing almost on a monthly basis, and the standard then requires you to do certain modifications. So just in terms of, from a practicality perspective, it did cause a lot of issues. Then what we also saw is the standard is very contract-based. So how you account for it is dependent on the clauses that you have in a contract. So in a lot of instances, there were no contracts, or they were very vague. So there was a need for we saw a lot of regularization in terms of contracts when the standard came.
Yeah, it was weird in the sense that you are leasing a building for 10 years or a piece of machinery for 10 years. They would argue that it's similar to you going to take a loan from the bank and buying that asset and then servicing that loan. So you need to recognize that you owe a bank money. So it was like, you want a market equivalent of what you have done. And I know the balance sheets moved. KPIs were not as beautiful as they used to be. And there was lots of data issues around IFRS 16. IFRS 9 too? Were you involved with IFRS 9?
Yes, IFRS 9, certainly a lot of issues around data as well, because then you needed to incorporate forward-looking information. For context, IFRS 9 was brought about the expected credit loss model, and you had to incorporate information like forward-looking information. You needed to look at the history, but what we found is in a lot of instances that pattern was not available for banks to predict future patterns. Right. So I think data generally is a problem.
If I ask actuaries in this room, I won't pick anyone, I want volunteers. Why do you use the discount rate that you use? Any actuary in this room who is evaluator, why do you use the 6.5% or 6.7 or 7%? I don't know, whatever you use in evaluation. Why do you use it? Just keep that on your mind. I'll give you an hour to think. And then you can then respond. Right. So there are different types of implementation approaches. There is a top-down, where you sort of look at IFRS 17 from an end. This is the end I'm trying to reach. So you start by capturing, how do I get to this end? What are the key pieces I need to put in place? And you then cascade them down to your individual policies and procedures. The second one is a bottom-up. You start from your bottom, you list all your contracts, you put them down in little boxes, and you list everything that needs to happen, and then you start aggregating, going top. What approaches have you guys seen? Albert, and I'll come back to Anesu, and yeah, what approaches have you seen working and why?
Yeah, I did personally see a combination. The bottom approach, the bottom-up approach, maybe I would recommend that one for specific reasons. Firstly, you then realize that when you midway through execution, that's when you actually realize that there are some loopholes that you actually didn't predict. So bottom up and deal with issues as you go. I've seen that one working. Thank you.
So meaning you take a product, you analyze it, you calculate its revenue account. At the product level, you construct its balance sheet, and then you sort of say, okay, now we've learned how to do that. What has been your experience?
So my biggest experience, I think, I'll talk to the implementation of standards generally. So looking at IFRS 16, IFRS 9, and IFRS 17, the biggest challenge is we find ourselves focusing on the reporting. We miss the essence of the standard, because the standard is reporting an economic transaction that has happened. But this economic transaction is designed by the entity and by the shareholders, or who has crafted, and they look for a certain intention to come out. And as you're saying, bottom up says, with this portfolio, what is the intention? And by the time we come out the numbers, you have to have understood that intention. So I think the biggest struggle is to say we need to comply and have numbers. Standards like IFRS 9 and IFRS 17, they are beyond numbers for me. They are supposed to change the business model and the fundamentals and what we're actually supposed to do. So it starts by putting the team together. Who is on the team? Is it the accountant and the actuary only, or the business? And I think where we struggle, the board and everybody to come through and say, according to, because when you look at IFRS 9 and IFRS 7, they're talking to solvents and Basel. It's risk management, this ZCAP we're talking about. So if we miss that part, it means we focus on the numbers and we miss the whole business that we are supposed to first understand, consider certain risk, mitigations or strategies, and actually make sure that we have captured them or corrected ourselves before we finalize the standard. So I think for me that's the challenge, where we're just looking at the numbers and coming up. Also, CBZ did this, so we do that. FML did this, then we do that. And we are not looking at ourselves and how we comply to the standard and what's not covered by the standard.
Nothing more really to add, but I think because it's mainly starting from the product portfolio going up that we've generally seen. Yeah.
Now, the biggest struggle with any implementation is if you've got a pen and a paper, write the spelling. If a pen and a paper, write the spelling. EXECUTIVES. EXECUTIVES. That's the biggest struggle with any implementation, right? And I think we've sort of delved into, these guys are chasing animals. They're chasing 10-legged animals. And sometimes for you to sit down with them and tell them theories and coverage units, we're going to allocate this based on a proportional basis and then discount it. And how have we dealt with executives? You don't have to say in CBZ.
I think indirectly we touched on this one, Tawanda. It's a hurdle. It's a difficult animal to deal with. So to go around it, in most cases, such implementation projects need to start right from the board. Then the board is constantly asking for feedback. And from that point of view, you start seeing, I think, things moving. But yeah, indeed, it's not an easy work. Tawanda, thanks.
And I always wondered what the world was going to say about actuaries after IFRS 17 came live, because for the first time, I think we were really required to communicate effectively with the board in a manner that they understand and appreciate. I know Deloitte is very strong on board engagement and education. Just tell us the strategies that you have put in place at Deloitte to make sure that there is total engagement right from the teeny mouse in the office to the highest position.
So I suppose speaking in general, when standards come into play, as well as for IFRS 17, what we do is you have to make the board aware of what is happening, because a lot of the times your board has a mix. It's not just accountants, you've got lawyers, you've got doctors, etc., and they have no idea what IFRS 17 is and what it would bring. So it's very important for the board to be educated, at their level, just in terms of what's key for them, so that they get an appreciation of the extent of a new standard. So once you have that, it's almost like you have that. You've given them that, that need to make sure that that's actually happening. So what we then also do as well, we try and discuss with our audit committee chairs to ensure that they have a project plan in place. They are comfortable with what management have put in place for their project plan. And we also set out certain criteria and things that they need to be looking at in terms of milestones from a board perspective, just to assist them and also hold them to account, because ultimately the tone needs to come from the top.
Right, that is great. We're going to go to what were the key hurdles we faced, but what key messages, Anesu? If I'm a board member and I'm receiving a report from an IFRS 17 implementation team, what key messages do I want?
I think it's very important to first understand the role of the board member, the board, and mostly the audit com, who drives the reporting in an organization. And there are two aspects. It is, first of all, dealing with public interest, especially for public interest entities listed and so forth, and working with the external assurers to say what has been done by the entity is appropriate for consumption outside. And you want to prepare those stakeholders, that's the shareholder, the policyholder, and the users, the investors for listed companies. And you want to be able to walk without getting into the detail, but to say, are they understanding where we are coming from and where we are going? An investor would like to see how profits are going to be coming through and whether we are going to be fine with what we have. So preparing the board to that language to be able to engage with investors at the higher level. Policyholders are looking at their value. Is this company solvent and so forth? When this thing comes out, what does that mean? So preparing the board to that and what it means from regulators as well, and generally meeting compliance. IPEC said by this date you should have done this. Are we going to meet that? Okay. The key aspects then is to also promote or support the resourcing, which was an issue in Zimbabwe right now. It was an issue. Accountants, actuaries, and so forth. They were very scarce. So from a board, that becomes an issue. I would like to highlight a very critical aspect which I've struggled, and I don't know whether that's been solved. In 2012, one of the key things we pushed from an IPEC point of view was, for an insurance company, I don't think it's adequate for the auditor to be the only one who signs financial statements of an insurance company. I think they're too far removed. We would need independent actuary sign off on those numbers and have that twin. Other markets are doing it. If you go down South Africa, the auditor signs and the actuary independent. There's a separation between statutory actuary and an independent actuary. For me, I think it's very important because it really suffices the completeness and the assurance that's required.
So if you're an actuary in this room, you must be behaving like a greyhound in the bush, and the rabbit has just been scratched and is bleeding. Eh? You must be smelling blood for more money, isn't it? Thank you for saying that. So I think as we are involved in implementation, to the actuaries in the room, when we are discussing with our boards, and I think Mr. Woto, Rutendo, and other senior executives in this room who agree that budgets, they want to know what budgets look like. They want to know what is the impact on reporting, timelines, deadlines. They want to know impact on finances very clearly. and they want to know what competitors are doing. The first message I got from a CEO was to say, hey, other companies have reported IFRS 17 numbers. What's happening to our group? That's the only time the CEO has ever been interested in IFRS 17. So I think board members, as actuaries, we need to learn to communicate with board members. Less of the graphs, less of the formula, more of what are the strategic deliverables. Now, I want to talk about hurdles. I know you guys have now seen companies go live. What were the hurdles along the journey? I want you to give me just the top 3, or maybe top 2, that you say, hey, this one was a pain, okay? If you're at liberty to do that.
The first one, Tawanda, is to get together a team that consistently looks at the project. Complicated, the standard is easy. It requires someone from risk management, someone from IT, someone from finance, an actuary. Then you also need someone from business. These guys are sitting down and creating a policy. You need to understand the terms and conditions of those policies before you start classifying them. So you largely set up a meeting, set up a committee. It meets once, twice. Then you start to see some members drifting away. So it has really been one of the key issues that you actually need to contend with. Secondly, there has been unmatched demand for appropriate resources on the IFRS 17 project. Given that it is a new standard and the resources are really scarce. So that was quite an issue, I think, on the implementation of IFRS 17. Then my third point would be the budgets. So you see, you are incorporating a team member on the project, who in themselves they do have other deliverables, right? So to actually balance off between the project and their day-to-day has really been an issue at Tawanda. Thank you.
Technical issues, technical challenges. What were the technical challenges?
I think some of the technical challenges that we've seen clients facing are mainly around the expenses allocation. Sometimes, making that distinction as to which one is an insurance expense and which one is not, particularly for those that are not obviously clear. So that, I think, was one of the biggest challenges that we saw.
Implementation of technical papers. So for the benefit of those in the room, implementation of IFRS 17 comes with no less than maybe 8 technical papers. Sometimes it can go up to 10. It transforms the entire financial reporting framework within a business. It changes the chart of accounts to a large extent, especially for life insurance business. And to align the new chart of accounts to the new reporting requirements of the standard, I wanted you to mention the transition. Now that we've done the conceptual framework, we've written all the nice English. Actuaries actually write very nice English, by the way. They write very good English, big reports. So the conceptual framework is there. We've written all these things, coverage units, principle-based, what, expense allocation. Now we say implement, all right? How did you manage that transition? Or how did you see companies managing that transition?
I think just certainly there were challenges, particularly from working day timetable, as Albert mentioned, because in a number of instances, this was done as a rush, right, towards the end. So you would find that there was not enough time, to do what was needed. So that really affected, people when they were trying to do this. But then just going into the transition itself, we found that because of data challenges, companies not having enough data, a lot of the entities did not go the full retrospective approach. So there are 2 approaches. the full retrospective approach and the fair value. So because of those data challenges, a lot of companies opted for the fair value approach. I don't know, is that what you're asking?
Correct. That's
Yeah,
correct.
okay. Yeah.
Discount rate. Anesu.
So definitely Zimbabwe very difficult on the discount rates in terms of saying, and I think this is not new. We saw it with IFRS 16, we saw it with IFRS 9. What is the market discount rate which should be used to evaluate? So that was a big one. Just also to add onto the issue, I think I also felt a surrender by insurance companies, and especially because of the tight deadline. We get consultants to do work, and we need an output. And this says to me, we have not yet started implementing IFRS 17, because the implementation was done outside. And if we get numbers and are happy with those numbers, it's only until those that are custodians start the actual implementing themselves, knowing why this is there, this and so forth. And I think there is still a struggle there, because then even on the audit, you then have auditors now talking to outsiders and not, so I think I'm talking to ownership in this across many, because of the pressure, there's no time. So like what my brother says, let's have the numbers, let's talk later about understanding and so forth. It's because the challenge on the technical now is, you may make certain assumptions and put certain items which are not talking to what the business is actually doing. And that's
Just to get numbers.
Just to get the numbers.
No, I think you make a strong point. And this is something that we have seen across many entities, particularly companies that did not have strong actuarial teams. In a production environment, they continue to rely on the consultant. So you've done your implementation, you're finished. The consultant, the project has been signed off. Now they want to download data to do their own numbers. They call you back that you need to help us with our IT system, come and look at our data. And so you then find you become an appendage, like how Russia took Crimea to itself. You just become taken by the company and you're appended, and you are now part of the business. I think it's important for companies to understand they need to actually invest in actuaries. Have a financial reporting actuary. In terms of discount rate, for now, we're taking whatever Robbie is pushing out from IPEC, and we're going to run with that. 10% is what is in ZICAP. We're going to use 10%. That's how life works. By the way, the standard allows for comparability. It actually requires that there is comparability with market parameters. So a lot of the time we end up saying to our clients, don't haggle too much with this one. Just look at what IPEC has published. Take that one, and then we'll deal with it later. What things have you said we're going to do? This is what the standard requires, but practically, I think this one we're going to agree that we're not going to bother with this one. Are there things the way you have decided that are now? Let's forget it. For example, risk margin, evaluate risk, blah, blah, blah.
It has not been easy, Tawanda. As you mentioned, just to correct you, it has actually taken 20 years for IASB to produce this standard. So I can tell you it has not been easy. Excuse me. It has not been easy to come up with this standard. So you can imagine we want to compress it as Zimbabwean entities for that sake, for that matter, to compress it and implement this within 1 year. So there are obviously quite a lot of technical issues that are coming up. You've got the theory, this is what the standard says. Let's come back and implement it on the ground. The standard actually says, day one, you estimate your future premium. What sort of entries do you pass when when you don't even have a single policy? So those sort of issues start coming up as you go into the implementation phase. What happens every day a policy is underwritten? What entries do you pass? What do you credit? What do you debit from an accounting point of view? So there has been quite a lot. I'm glad IPEC has been forthcoming with I think the no premium, no cover. That was a big issue, I think, on the short-term side. The standard actually says what you take as premium is what has actually been received. And we look at premium receivables, they've ideally been scoped out of IFRS 9. So where do they sit? You go to IFRS 17, IFRS 17 says no, there are no premium receivables. So for a Zimbabwean market, which is particularly different from the rest of the world, how do you deal with premium receivables? So those sort of issues have been a challenge, and like I mentioned, I'm glad that IPEC have been proactive and they've issued that statutory instrument. Tawanda, other than that, I think let me pause here.
Anesu, I want you to close this segment with interaction of the standards. IFRS 17 interacts very strongly with IFRS 9 and with IFRS 15. What sort of issues? He has already touched on it. IFRS 9 does not deal with premium debtors. IFRS 17 obviously says go back to IFRS 9. IFRS 15 also comes. What are you seeing in the interaction on those standards as further complications of the implementation?
I think the first thing is what you touched on, which IFRS 4 couldn't drive, to say revenue is what has been earned. So that comes through very well from IFRS 17 and in alignment with IFRS 15. What's also very critical is the portfolio approach, which IFRS 15 did bring, and I'm sure there's always reference back to IFRS 15 on similar contracts and so forth. And I think the allocation story using the standard standalone selling price in terms of allocating certain items, and like has been pointed on the debtors, there is assumed no credit risk on insurance contracts. So if there's no credit risk, for me this has been a very big issue, because a lot of our insurance companies has been sitting with insurance debtors. So if there's no credit risk, and if you go to IFRS 9 on what qualifies for credit risk impairment, insurance debtors are not there, because the assumption is it's been paid. The impairment stories become an issue.
Right.
Okay. So I hope the alignment, and that's why the connection with the regulator is always very good, where they then bring this in terms of the SI that you're talking about. However, the challenge is you still had a contract and understanding with your policy holders and a way of doing business. Yeah. How do you reconcile the two? Yeah. Because a company, some of these big companies would wait for 2-3 months and they'll still pay you. Yeah. How do you reconcile? So I think there is that. I am not so sure when we're looking at IFRS 17, are we reconsidering our IFRS 9 considerations? Because when IFRS 9 came through, there was delay or expected delay or an adoption in IFRS 4 that says if you're an insurance company, relook at yourself and say, I'm a pure insurance. If I'm totally pure and there was a criteria, I could defer IFRS 9 and wait for IFRS 17. If I'm not a pure insurance, I could implement, and there was the overlay and the two approaches that were allowed there. So I think it's very important to reconsider, as IFRS 17 has now come, are we aligned with what we are doing with the IFRS 9? Because these two things are connecting, right? Some may have forgotten that they actually did not implement IFRS 9 for whatever reason, which means the current one is IFRS 17 and IFRS 9 at the same time. Right. That's actually what's, especially for the pure insurance, you're supposed to be doing both at the same time. But as you talk, it's IFRS 17 and forgotten IFRS 9. So I think it's a very important one as we close. But just also to highlight, one of the key things I find challenging is the involvement of the auditor in this whole process. We talked about 10 or so technical papers. And as we're talking about the debtors and things, and I would want to encourage, especially for the insurance companies and for you statutory actuaries, as you work, to say within your project team, put your external auditor, not for audit, but to walk through when you get to a technical issue, you have an agreement and, okay, I know it talks to budget, to then only expect audit to come flawlessly and perfect at the end when you've made all these decisions alone, I think it's unfair and not a good approach. Put that separate budget for implementation. When they will audit, but at least they've worked with you and they understood what you were doing all along.
Today is a good day for auditors and actuaries. We have a lot of money to make, all right? I think well balanced. This segment is quite well balanced. IFRS 9 comes in, either you're going to issue a debt instrument to your favorite client through your bank. You can no longer issue them a premium credit, isn't it? Premium loans. You're not a bank, you're an insurance company. IPEC will arrest you for doing business outside your license. IPEC. Right, we want to close this segment and we want to take questions. Anyone with a burning question? Comments? Okay. Our microphones, there are questions here.
Can I go? I don't have a question, I have a comment to just agree with some of what the panelists were saying. In the first place, it's for the operations people in the business to own the IFRS 17, because the data is theirs, the processes are theirs, and the rest of the people involved, particularly the actuaries and the accountants, some of them may not be in the business line itself. So in our group, clearly the IFRS 17 champions are the heads of processes in the company. But also just to add that the audit committees, they've also undergone at least 2 sessions of training on IFRS 17. And I think that it's a long shot, will go a long way, but it has brought to the fore a number of the issues that the business need to understand, even as they were doing very well in their own understanding. And we always had, if you are running both the general insurance business and the health insurance and the life company, the meaning of revenue was always tended to be looked at as the gross premium written, but we always were not look at the cash and compare it with that, but it didn't take into account the fact that some of it is waiting for certain future liabilities. So I think that we feel it's too ambitious to expect a country like Zimbabwe and the many companies, especially the smaller ones, to be able to comply with IFRS 17 in 2023 in December. I think it's ambitious. Last week I was in Australia at the International Congress of Actuaries. And when we discussed IFRS 17 for 3 hours, so your 2 hours is not good enough. The rest of the world is in the same quandary. There's no one who is much ahead of what we are doing when I look at what's going on at First Mutual Group, and they acknowledge that it's not a simple thing. So maybe we were too ambitious to let the regulator go to the authorities and say that we are ready, we are not. But if a number of the bigger players are ready, maybe the regulator should allow some of those who are not ready to defer that and do it when they are ready. Thank you.
Thank you. My question, I think it's both a question and probably a comment in the same vein. So the first one is really around, I think, a comment that Anesu made, which is really that we then forget really what the standard is trying to do or achieve, and we focus on getting results. So I think that comment, as I was reflecting on it, I did think about product classification. And in hearing some of the discussions, or maybe coffee time talks with people, you start to see that the classification decisions are now being made more from an expedience perspective. and not necessarily to achieve the overall objective of the standard. So you see people are trying to force everything to become PAA because it's a lot simpler, but that's not necessarily what the standard is trying to do. So I hope, I think through this process, we will get maybe the right results and we will make the right decisions. And I hope that as people sit on audit committees and as auditors look and review some of the policy and methodology decisions that were made by entities, I think there will be robust evidence that will be provided to justify some of the decisions that will be made. Otherwise, we run the risk of getting a set of numbers, but that don't actually support the actual IFRS 17. Then the second one, I think around implementation, I think you did not really talk about it, but more on the tools that need to be built or that need to be bought. So I think as OM, we went the build route. It had its own advantages, but it had also its own pains. So I just wanted to hear what the panel had to say around that, because I think that's something that has come with the standard because of the complexities of the reconciliations that need to be happening between accounting and actuarial numbers and the various disclosures that need to accompany the financial statements. So there's a lot that need to be processed once the numbers have been determined by actuaries and the finance inputs have come in. There's a lot that need to be processed. So maybe just to hear what the experience has been around that and whether people were going off the shelf or people were building tools internally. Thank you.
Okay, we're covering that in segment 3.
Okay,
Thanks.
Okay, thank you so much. Mine is just a quick comment on the premium financing aspect to then say I'm actually seeing an opportunity as well, especially if we've got banking groups in here represented, to then say we may need to then design premium financing products. So if an insurance company is not able to pay premiums upfront, you just channel them to your banking division. Go and get a premium financing product. I think it's happening. Because it has not always been the business of insurance companies to offer insurance on credit. Yeah. So that's what I wanted to say. So we are effectively out there trying to actually help banks to to solve that gap. Yes.
So the session has become also good for insurers. Actuaries are happy, accountants are happy, now insurers are happy.
And banks as well.
And banks.
Thank you.
Thanks. I think there's a question over there.
Yeah.
Thank you very much. My question is on all this work that we're doing is to produce a report which goes to someone. Now, this report is not for ourselves, the preparers, which means we may have a very good understanding of how to come up with a report. But the people that are going to be sitting with this report to make a decision are probably not accountants, are probably not actuaries. So it would be very sad to see all of this work go to nothing when the report gets thrown away because the actual use of the report does not understand what is a CSM, what is a fulfillment cash flow. So how much work has been done to prep the users of this report to understand them, that this is what's coming. We are sitting here to change someone else's report. Do they understand these changes and how it affects the decisions that they're going to make out of them? Thank you.
Yeah, I think we talked about board engagement. So Albert touched on the composition of the implementation team. It needs risk management, accounting, actuarial, board, and so on. And Anesu talked about board communication. You are quite right that if that is not done, then it becomes very sad that we've done all of this and people don't get what was the whole fuss about. So here is an opportunity for us, particularly as actuaries, to say what we were trained to do, finally we are speaking at the right level. Because once you start affecting profit and loss, these guys sitting in front here, they become your best friends. You will have lunch with them for the first time in your life. These ones. Unless you want to add?
Add and say, it would be good to eventually think of the wider investor and have some sort of watered down maybe training or video or whatever that just talks to what is going to come out of this standard. This is where we were. This is where we are, where we are going, and this is how what these numbers at the highest level. Because I really appreciate the key issue that says we've done all this work to allow somebody to make a decision. Do I buy shares? Is this company performing? How is it different from this one? And it's probably not the one sitting here, both as a policyholder or an investor.
Correct.
Just to have some sort of, it would be good, and I guess probably from an IPEC point of view, and for the industry. The reason why I also raised this, for me, the biggest issue is I keep on being afraid that the industry is under threat, especially in Zimbabwe at this point in time. And we all need to go out of our way to promote the industry.
Yes.
Right.
Thank you. I have a comment and a question, especially on IFRS 9. So, from my experience so far with most of the Zimbabwean enterprises and Zimbabwean banks, we still have most of the IFRS 9 modeling experts. Most of them are accountants. So as a model validator, I would tell you that, okay, the intensity or the reliability of an IFRS 9 model developed by an accountant, not really to be critic of our accountants. To gain comfort from a model, a credit risk model developed by an accountant, you have a lot of challenges which you then pose to the model developer. That's, okay, you are saying this and this. How about you try to probably implement or apply VASEC model from converting your TTC PDs to PIT PDs? That becomes a challenge, like it's a totally headache to an accountant. So I think it's a question which comes to the actuaries or people with mathematical background to invade that non-traditional workspace. Because most of the actuaries were venturing into the traditional insurance work and were not really broadening our expertise to the non-traditional route, like that of being probably a quant. I'll say this from the experience that I had with those banks that are outside, for example, those banks like from outside Zimbabwe, like eastern side. You know, their models are too intense and they really make sense. If you go through the model, you can really see and follow what's really happening. And if you check, most of the time, those model developers are actuaries. But we don't have that in Zimbabwe because few actuaries are in the IFRS 9 modeling space, right? That was a comment. And then my question comes into, I'm happy I heard there are some actuaries who are having the IFRS 9 modeling approach, who are specializing in IFRS 9 as well. I wanted to ask, there is a belief with some supported literature which says the use of provision matrix and raw rates in computing the loss rates makes, or if you use provision matrix or raw rate in computing your loss rate, your model automatically becomes forward-looking. I think that was an approach which was adopted after the challenges which we have with probably obtaining our data to compute our MEV models, the macroeconomic variables to use for forward-looking. So I wanted to ask, how reliable is it to use provision matrix and raw rates in computing loss rates, which automatically makes your model forward-looking? Thank you.
Okay, thank you for what was evidently a bit of a lecture, but I think you do raise some good points. The first thing I want to say is we will leave this convention with great respect for accountants. Chartered accountants are very smart people, very well trained, and I think they occupy many spaces, as we also do. And IFRS 9 is just one of those areas where sometimes you find them dabbling into, because they would have found a way around. They are probably communicating better to the stakeholders, and they say the moment you put a formula on any document, you lose 60% of the audience, and maybe accountants have just found a way around that. I'm going to give to my senior to respond as well, but I think you talked about a specific model which meets certain criteria in your view, and that's fine. I think the big point is when I did IFRS 9 modeling, I found some very weird relationships in this country because of hyperinflation, right? In many countries, when inflation increases, defaults increase. In this country, when inflation increases, defaults drop completely. Because the principal loan amount remains static and the ability to pay increases. In other countries, inflation increases, people are paying more for electricity, for Wi-Fi, for medicals, so they have lesser disposable income, hence they are less likely to pay. So whatever model you're going to use, document it properly, backtest it correctly, make sure whatever variables you're going to use pass the validity tests that we were taught back at university. I wouldn't want us to leave this convention to say there's a provisional transition matrix, that thing you said. Just get the answer right and make sure it's valid. I want to give the mic, Tavatso, can you please give to Ms. Kafeso? Our mic, where's our roving mic? Yeah, please bring it.
My comment is that my comment is that once all has been said and done, there's a lot of collaboration that we need across disciplines and also across countries, companies. So for example, if I'm a smaller insurance company, I've seen Douglas is advanced. Why don't you go and get some insight on the challenges that they're facing so that you don't repeat the mistakes that they've done? We've had Mr. Mashoko talking about ZICAP. And some companies are struggling. So there is that collaboration between across disciplines and across companies that we need to help each other. And also I appeal to the Association of Insurers, Association of Actuaries, just to put literature. There's a lot, we could put a lot of literature that will help people to implement. Yeah. But the problem is that if you just work in silos, we will not achieve. But I think we can be moving. I always say that we had landlines, but now we're using cell phones. Who knows about landline? We no longer know about that. But there was that implementation that everybody, there was a buy-in. So let's have those who are experts in that, and for those who have gone a lot of consultants in this IFRS 17, write literature, write manuals, write something that people can simply apply without struggling with this jargon, but be able to say it can be simplified to this level. But I have seen that let's work within and across disciplines.
You hear that, young man? Words of wisdom from the seniors. Right, we want to go to our last two segments, and I think we'll just combine them because they speak about the same. We're going to talk about, okay, we'll take a comment from.
Okay, thank you very much. That's more like a technical question that you asked. And I think in response, under IFRS 9, there's no prescribed approach to use. So you have a wide array of approaches, from simplified approaches to sophisticated approaches. What all those approaches, from raw rate, transition matrices, survival analysis, up to regression, you are calculating PDs, probabilities of default. However, what the standard is requiring, on top of that, you have to make sure that there's some element of forward-looking information that is induced in those parameters. So whenever you're calculating a PD, obviously you're calculating a forward-looking estimate. But we are saying over and above just using your approach, make sure that
you incorporate forward-looking information to then tell us that if this is going to be the kind of economy that we are experiencing in the next year or 2 years, your PDs are going to change this way, so that they become point in time. Because if you look at a transition matrix, you are just using historical information to understand how maybe facilities were migrating between stages. But yes, it's a prediction that you can use for as your PD. But the essence of the standard is essentially trying to say, okay, you're operating in a certain environment where there are macroeconomic fundamentals that are changing. How are you then adjusting your numbers based on what is happening in the environment? So they are not purely forward-looking when you just compute those. You have to make sure that there's that extra layer that incorporates forward-looking information.
Thank you so much for that additional comment. So we want to talk about go live, all right? I know there are entities that have gone live. Taurai already asked what are the tools that are being used on go live. I know there are consultants in this room that have also overseen companies going live. Albert has gone live. I see a number of companies publish Q1 numbers have already gone live. I know First Mutual has gone live. I know Old Mutual has gone live. Yeah, I don't know who else has gone live, but yes, a few companies have already gone live. So the first question that that Taurai asked, we are not marketing any IT systems, but we can speak in general, all right? What are the sort of general approaches that we are seeing in terms of what solutions are available in the market, what sort of costs are we seeing for IT systems, and what are the various forms of engagement with IT vendors that we have seen across our different experiences?
Thank you, Tawanda. I do acknowledge that as Zimbabwe, we started off very late in the implementation of this standard. So you therefore find that to actually try and come up with a solution in-house was going to be time-consuming and costly as well, in the sense that we didn't have the resources, and therefore, I think for some of us users, we therefore tended to go with the off-the-shelf solution, at least for now, for saving of time, and also while we actually build capacity for the future.
Yeah, I have also seen majority are going off the shelf, and there are two options that I've seen. There's a full license option, which is offered by quite a number of the companies, and then there's a managed service option, again, which is offered by a number of the vendors, and most of the vendors have got those two variants. Managed service is targeted at small entities, probably with premium. If you are looking at a global scale, they'll say premium less than 20 million US is small, all right? So they'll say this one will go on managed service. And then a full license, anything above 20 million and so on. So very popular in this market, I think. Lots of Indian solutions, lots of UK-based solutions. And the price ranges that I have personally seen, they start for license fees. They start from as little as 5,000 per annum to as much as $200,000 per annum. Just depends how big your entity is, how complicated it is, and whether you have money to spend. What have you guys seen in terms of IT systems?
Okay, I think for me, the key issue which I really need to bring to the table is IFRS points out that there should be a balance between cost versus benefit. And until you get that balance, I think sometimes we then go for the systems to solve for us and only realize that some could be a very simple process depending on the business. So it is your business and what you are underwriting or what you are dealing with, which should be matched to the system and not the system implementing. Some use the system to implement, but I just want to underline that IFRS focus brings decision makers to say, what's the cost versus the benefit? and it should not go beyond. So you can still do without a system as long as you can come to some numbers and justify.
Yeah. Madam Auditor.
It's just around group audits. Hello? Okay, nice done. So just around group entities, what we've just seen as well is there's still a bit of a struggle in terms of integrating the solutions for IFRS 17 with the ledgers. So there is still a lot of manual processing involved.
Yeah. In fact, I wanted to come to that when looking at the Go Live environment for those that decide to build their own solutions, all right? As an auditor, what are you going to be looking at? So I show you a nice Excel sheet that this Excel does fantastic numbers for me. What are you going to be looking at?
This is an Excel system.
It's an Excel-based system.
So generally we'll look at things like, firstly, the integrity of the data itself, whether it's reliable, whether it's accurate, whether it's complete. So that's probably looking at a sample of the underlying information to confirm. We'll also look at the controls, yes, even around that Excel, to say who has access to this Excel, what controls are in place if there needs to be a change, who gives approvals for the changes. And then we also look at the calculations as well. Would involve our data analytics teams because it would be voluminous. So it's also just checking the calculations, the accuracy thereof.
Right. I find that interesting because of the data groupings that come out of IFRS 17. So remember, you group your data by product first, then by year of issue of each particular portfolio. Then on each portfolio you go on whether a certain group is loss-making or profit-making. So you could end up, for example, if it's a short-term company, very easily could end up with 15 groups or 18 groups. And each group needs to be calculated in that model. And then there needs to be consolidation. So you've got your Excel files, they're doing your calculations for each subgroup, and then there's somewhere, I don't know whether there's a database that you set up in Access, Microsoft Access, I don't know how you do it. You set up a database, and then those numbers are then feeding into some sort of consolidation, right? What's your feeling about that? Just the way I'm describing it. I know you're not passing anyone or failing anyone, but what's your feeling around that?
Just in terms of the preparation process, because there is a lot of manual processing, it's prone to a lot of risk and errors, so there needs to be enough controls just around spot checking and seeing whether that Excel or that model is working as it should. Then it's also important to have some documentation or some papers just around exactly how the groupings are done, because it's not going to be possible for someone to check that each and every individual line items, it will be done, on a sample basis. So it's very important to have an expectation of what exactly is happening in each group, how the group has been determined, and all the underlying information is there to support that data.
Rumbidzai is well trained. She calls a spade a big spoon. But in short, she's saying you will not likely pass that audit. What's your view, Anesu, of that setup?
So I think the first thing is it would be good to do it to understand the extent, but eventually migrate to an automated system. Because I think automation will definitely bring efficiency to the whole process. It can't be something then that becomes permanent and okay. I think one entity where we were supporting, they said we have to relook at the model because the finance executive who was overseeing that lost his laptop. Where so in other words, or the person who's been playing and working with this thing just decides to, is it what to call it, hold the entity at ransom. because they know where all this is. But if it's driven by a system, eventually it's a system-driven solution. It will be the best, actually.
Albert, I want to talk about integration. It's very unlikely for most companies to buy a new insurance company administration system and to buy a new insurance company accounting system. Most likely they're going to keep the operating system because you've already spent maybe 200,000 US or so. Your accounting package has been in place for 5 years or so. Now you've got this IFRS 17 thing coming in place. How has the integration been, and what sort of challenges have you seen, and how can they be overcome?
So, being a new standard, and we also yet to see how the 2023 year end pans out. That sort of discussion has been shelved temporarily, pending the outcome of the audit process. Then once all stakeholders are happy, I think we then go into that discussion regarding the integration. Thanks.
But I suppose the desire is that there is integration. You come from data, it feeds into the IFRS 17, and then it feeds into the sub-ledgers and into the general ledger. Now, without integration, it means there's going to be a lot of manual inputs. So you have one process which produces IFRS 17 insurance accounts, and you have another system which captures all the other processes of the business, and then someone has to come now with their calculator and start adding the two. How do you envisage that process will happen, and what will be the challenges?
So it will definitely be a manual process. There will be a lot of, are you asking me from an auditor perspective, by the way?
You're speaking from an auditor's perspective.
From an auditor perspective? Yeah. Okay, all right. I do have my clients in the room, so without sounding like I'm justifying audit fees, we do anticipate that there will be a bit of work around that, because ultimately that is the data that will be producing the results which will be in the financial statements. So for us, it is absolutely key to obtain comfort, firstly around the IFRS 17 solution that's producing the results, and then we test whatever manual journal entries that management would have prepared just to put those through into the accounting ledger. So it's a manual process, and based on that, there is a bit of work around that.
So it most likely involves modification of the chart of accounts to create those postings. So you produce your IFRS 17, then there's on the accounting package, you have created a new window where you now post these numbers.
Yes,
and
exactly.
Then they're put in the general ledger.
Exactly.
Okay.
And in fact, that's what we are seeing.
Yeah, you see, guys, I'm already speaking accounting language, eh? Sub-ledgers, general ledgers, TB, which is quite fantastic. Now, we go to issues of reporting design. I have seen a draft template done by Deloitte with 126 pages total, with about 100 pages of disclosures. This is for full reporting, because each group is disclosed with each CSM for year 2012, 2014, 20 blah, and for all the portfolios you've created, and then you consolidate, right? Now, these are the practical things I was asking you, that have the things that you have said, you know what, this is nice, but we're not going to do this. I've seen companies that have said, we're going to disclose for up to 4 years or up to 5 years, and 6 years and beyond, we're going to lump it up and use a fair value approach, all right? Some companies have gone for fair value approach from day one. Each one has its benefits. Do you guys envisage the 126-page disclosures across the board? Or maybe not 120, maybe 80, or, right? Disclosures are how many pages? About 30 right now? The finance report is about 30.
No, about 100.
Currently it's about 100. So the IFRS 17, how many pages is it going to go to?
Certainly, the disclosures under IFRS 17 are quite handful. At this stage, we have not quantified, but there are certainly going to be a bit more pages.
I agree with that, and just in line with a previous comment to say that all this work has been done, but ultimately it boils down to what the user is saying. So because there's need to make the user appreciate, there's a lot of judgment that goes in there, right? Contract service margins, how the risk adjustment has been determined, how future cash flows have been determined. And IFRS 17 then requires each entity to disclose that, what they've done, the assumptions that they've taken. So that is expected to increase the disclosures. But ultimately, I think then it's for the benefit of the user, because then they get to understand what really went in.
Yeah, so a lot of work around reporting design and disclosure design, and probably this is where the executives get interested. In the last 5 minutes, and the next 5 minutes, because I'm about to pause and hand over. In a live environment, we have a number of issues that are going to change. KPIs, impact on revenue, profitability, equity, introduction of risk adjustment. We also have interaction with ZIMRA. I don't think ZIMRA is going to stop taking VAT on premium. Are there any ZIMRA officials in the room? I don't think they're going to stop. That's my own opinion. Insurance premium tax. Then we've got IPEC and ZCAP. There's lots of premium-based entries in ZCAP, which you multiply this by premium, you have your output as a measure of riskiness. But premium looks like it's like Chelsea. It's been thrown out of the league completely. But it still is referenced in a number of statutory reporting requirements, right? How do we navigate? What do we see as navigation around these parameters? Because it means your VAT is going to be based on a parameter that doesn't even affect your performance. In fact, is ZIMRA going to do taxation of your business on IFRS 17 or IFRS 4?
I think two key comments, Tawanda. Let me start with the ZIMRA one. ZIMRA is its own way of taxing. If you look at the short-term side, through the eighth schedule, it's on a cash basis for all insurance business. So ZIMRA will certainly come and look at your bank statements and say, this is how much you collected, this is how much you've paid. So there are some adjustments that we then need to do, especially on the provision side, which are allowable for tax purposes. So in terms of the statute for taxation, it has not moved, so nothing has changed. So certainly those reconciliations are going to be required. Now coming to the transition issues, 2023 is going to be very key. There are certain KPIs that are going to be kept. I think grudgingly, even when we want to quickly switch to IFRS 17 reporting, on the marketing side, what we know is an underwriter must bring in so much in terms of premium. So that KPI is most likely going to just to stay. Then I think coming to the other bits regarding the taxis and the like. Remember, we do have our core systems. There's not been much change on our core systems in terms of how they are structured. If anything, there will be additionals. For instance, just so that we then transition to IFRS 17 through an engine, for instance, for example, that IFRS 17 software that we then acquire, it is what then transforms the numbers that are actually coming up from the core system. But I think going forward, as I said, 2023 is going to be key as we try and reconcile between the accounting system, the core system, and the IFRS 17. So the discussion around the integration will then take place, I think, once we've seen the results from the implementation exercise
for 2023.
Thank you very much. I've got my last question for the both of you. What we have seen obviously is generally revenue has gone down a little bit. Profitability will generally go down because of introduction of risk adjustment, so equity. For you two chartered accountants sitting in the room, I've put on the screen the split between actuaries and auditors for audit preparation. And you can see there's a healthy split, it's almost 50-50. It's expected actuaries are going to play a bigger role for actuarial, for audit. What measures are you putting in place as you're preparing for audit? And what do you envisage will be the rollout of audits coming after IFRS 17 comes live?
All right. So basically what your table is also showing here and confirming is that our audit we won't be working in silos. So it's not just the auditors. So what the audit firms have done is to upskill their people. So we've got our actuaries actuarial auditors who will be assisting us in testing the actuarial section. We've got the IT auditors who will be looking at the changes that have happened in terms of the system to accommodate IFRS 17. We then will have the audit side to test the methodology, the technical papers, as well as the disclosures. So because all of this is additional input, additional work, definitely we do see that there will be an increase just from an audit fee perspective to take into account the audit effort that will be required to audit that.
Anesu already said the actuary will now need to sign the accounts.
Oh, yes, I think there is more. I'll probably want to say this for the actuaries. I was trained in actuarial by an actuary turned CA, and it was one of the best experience for me, and I also would like to challenge. It is my dream. I train chartered accountants. It is my dream to also see actuaries getting this second badge, because it's showing, and I'm thinking for her as an auditor, having an actuary who also speaks and has got the proper proficiency, that makes the team stronger. And that platform is now there to be able to work together. I just want to, probably not being, devil's advocate, I sit here and say, is this the final implementation of IFRS 17? Or we are going to start again very soon? Let me say this, when we implemented IFRS 16, we went in 2019, did IFRS 16, all the things that we're talking about. But when Zimbabwe started happening, the contracts started changing, becoming shorter monthly or everything. So it's no longer the same contract, right? The current starts changing. It was monthly, it then became US dollar. So you can't then use the same model for this new contract. So as I'm sitting here and listening to all this story, we have got much of Zim dollar contracts in the insurance sector, but the US dollar contracts are starting to come through, and we expect them to be more. What does this mean in terms of this implementation? Are we going to come again and start? I would like to leave that as key homework for business, because let's give a very simple example. As hyperinflation picked up, we started the indexing, putting annual contracts. Is that correct? Which means that contract is no longer the same as the portfolio of a 60-year or 30-year, 20-year contract. Meaning what you are doing now and what's going to be done on this new contract is totally different. What are we doing about it? And what are the thoughts on the table as we sit?
Thank you very much. It's live, so I'm sure Minister of Finance is listening, and they'll issue a statement soon to answer that question. Over to you, Madam.
Thank you so much. Let's give them a hand. You're not taking questions? You're done? Yes, I think. After spending some time with actuaries, I would say that the hunger in this room, I sense it has compounded. So I'm going to quickly go across to a representative from UNICAF before we take some time to go for lunch. And I would also like, while the representative from UNICAF is coming up, please can we give our gifts to just appreciate our panelists as we give them a hand. And our representative from UNICAF can come up. Are they here? Lovely. Let's give him a hand as he comes up. Yes, you can stand and you can give them. Yeah. Thank you so much. One more time, let's give it up for UNICAF.
All right. Afternoon, everyone.
Afternoon.
Actuaries, aspiring actuaries, auditors, and all those. It's a bit difficult to speak to people who are hungry. I can see a lot of hungry faces. All right. I'm Mr. Maere. I'm representing UNICAF. I'm the Business Development Manager. We are partnering with ASZ, where we are sponsoring this occasion. And as part of the sponsorship, we have a special package for all the attendees who are in this room. I believe on all in front of you, you have got flyers from UNICAF, where there are plenty of interesting degree programs that are listed on those flyers. So as part of the package that we have set up with Actuarial Society, everyone who is in this room and those who are attending virtually will be accessing a special scholarship if they intend to enroll for any of the programs that are listed. Just make sure that you have your details captured by the ladies at the entrance who are doing the register. You will be receiving an email with the specifics of the package that we are offering and how you'll be able to access it.
Wow.
So check your time, go through the virtue of, what was that presentation yesterday? Yes. Yeah, others will say patience is a virtue. So you can choose to wait for the email that you will receive, most likely on Monday, or you can choose to approach me immediately. Others say chinono chinengwe, so you can see me during the event or after the event, and I can share more information with you. But in the interest of time, and I can also see the faces are hungry, just know that there is a special package that we have set up, which will be accessible by all of you. Thank you very much.
Thank you. Ladies and gentlemen, would like to thank you. Please do go and enjoy your lunch. We will be back here by 1:45. Thank you so much.
want to know that our loved ones have been afforded a dignified funeral service when they pass away. Old Mutual, in its quest to always enhance the experience of its customers, has launched end-to-end funeral services to complement the existing cash policy.
Today, we add another enhancement to Old Mutual's product offering, a key milestone in the objective of providing customers with a one-stop shop integrated financial services offering.
Old Mutual Funeral Policy is set to provide clients with a superior financial plan as well as an exceptional funeral service experience.
As Old Mutual is saying, death is an event. The intention is for us to see to it that as our most valued customers, we are helping you to give your loved ones a befitting send-off as well as celebrating their well-lived lives.
Very excited by it. I think it's very cost effective, and what they have on display is of top quality. So I would recommend definitely myself and my family and co-workers to look into it.
The Flexi Funeral Service Policy offers features such as cash payouts on each plan, free cover for biological children, a nationwide bus service, family courtesy vehicles, and an option for cash in lieu when claiming.
Our customers kept asking for more. They loved the products, the funeral cover policy, which is a policy that would pay out cash benefits. The launch of Old Mutual Funeral Services business is actually a demonstration of our commitment to serve our customers better, to say that we are with you. Do life, we will cover you.